Welcome to The Deep Dive, a show prepared by QIP Capital Academy, where we take your sources and extract the most important nuggets of knowledge. Have you ever looked at, say, a super safe government bond and then maybe a volatile stock and wondered why anyone would pick the stock? Or maybe how investors figure out how much extra return they should actually get for taking on more risk? Well, today we're doing a deep dive into the risk premium. It's kind of this invisible force that explains that crucial difference and helps you balance potential reward with, well, actual risk.
Yeah, and it's really vital to grasp that a risk premium isn't just some piece of finance jargon. It's the expected additional return you demand from an investment that, carries more risk compared to a safer alternative. This deep dive will hopefully illuminate why understanding this idea is absolutely key for making truly informed choices. We'll explore its various forms and show how it applies to, well, everything from treasury bonds all the way to digital currencies.
Okay, so if I'm getting this right, it's basically like getting paid extra for stepping into uncertainty. But is it always a clear-cut premium, or can things like market conditions sort of warp that expectation?
That's precisely it. Consider U.S. Treasury bonds. They're generally deemed incredibly secure, almost risk-free, right?
Right, the gold standard of safety.
Exactly. Now, if you're looking at something less stable, maybe corporate bonds or stocks in emerging markets, you naturally expect a better return. So if a treasury bond yields, say, 2% and a company bond promises 5%, that 3% difference, that's your risk premium.
Ah, okay.
It's the market's way of compensating you, for the increased chance that the company might not actually repay.
That distinction is incredibly useful.
Yeah.
But beyond just understanding the definition, how does this actually impact your investment decisions, like in the real world?
Well, this concept is pretty central to powerful tools like the Capital Asset Pricing Model, or CAPM.
CAPM, right. Heard of it.
Yeah, CAPM essentially sort of estimates how much return a given investment should deliver based on its risk level. Specifically, its sensitivity to broader market movements. Knowing this lets you assess if a stock is genuinely undervalued relative to its inherent risk, not just its current price. It helps you avoid, overpaying for what seems safe. Plus, thinking in terms of risk premiums, it naturally encourages investors to diversify.
Diversify? How so?
Well, by spreading money across different asset classes, you aim to maximize gains without taking on unnecessary danger. You balance out those different premiums.
Ah, okay. And because risk isn't just one single thing, I imagine these premiums come in like different flavors?
Absolutely. One common type is the equity risk premium. That's the extra return investors look for when buying stocks over safer things like government debt, simply because stocks tend to fluctuate more.
Makes sense.
Then there's the credit risk premium. That applies when you're lending money to entities that might default, like maybe an unstable corporation. And here's an interesting one, the liquidity risk premium.
Liquidity, like how easy it is to sell.
Exactly. Imagine you've bought, a rare collectible. The thrill's great, but then you try to sell it quickly. Suddenly that illiquidity feels very real, doesn't it?
Oh, yeah, definitely.
Investors generally expect higher returns to make up for an asset that's hard to sell quickly without losing value.
You're right. That immediate illiquidity adds a whole new layer of risk. And if we think about an asset class known for its unique risks, like digital currencies, Bitcoin, altcoins, that sort of thing, they seem to carry a pretty significant premium, don't they?
Oh, they absolutely do. The crypto space is still, maturing and can be extremely volatile. You've got wild price swings, rapidly changing regulations, potential security issues, hype-driven markets. All that contributes to the uncertainty. So investors demand much greater returns to offset that unpredictability. That's why you see such potentially high premiums, but also, frankly, such dramatic drops.
Okay, so calculating this premium sounds, on the surface, fairly straightforward. You just subtract the return of a risk-free investment from the expected return of the riskier option. Like an 8% expected stock return minus a 3% treasury bond return gives you a 5% risk premium. Simple enough, but I have to ask, is that value static? Does it just stay at 5%?
That's a critical point.
Yeah.
It is far from fixed. Risk premiums are incredibly dynamic.
Okay.
Think about it. The health of the economy, major political events, global market shocks. These can dramatically alter investor sentiment. They can drive investors to demand more compensation for bearing risk. So when uncertainty rises, generally, so does the risk premium. And that actually pushes down current asset prices to offer those higher future returns.
Interesting. So bad news can mean higher expected future returns eventually.
In a way, yes, because the price adjusts downwards. Conversely, when confidence is high, premiums might shrink, making riskier assets maybe less attractive on a risk-adjusted basis. And of course, the inherent nature of the asset itself is it unproven, hard to trade, highly volatile.
Yeah.
That also plays a big part in its baseline premium.
So what does this all really mean for you, the listener? We've gone pretty deep on how understanding risk premiums isn't just about chasing high returns. It's really about understanding the level of risk tied to those returns and, crucially, whether it's justified for you. This concept is central to tools like CAPM, as we mentioned, and it really motivates why investors diversify their holdings.
And if we connect this to the bigger picture, ultimately, risk premiums highlight a basic truth in investing. Higher potential returns generally come hand in hand with greater risk. There's no free lunch, usually. So this raises an important question for you. Knowing that the price of risk, this premium, constantly fluctuates, how will this influence how you evaluate new opportunities? How will it help you determine when that risk-reward balance genuinely makes sense for your portfolio and, just as importantly, your own personal comfort level with uncertainty?